Welcome back, ladies and gentlemen. Listening to another edition of DIY Money.
DIY Money.
All right, Logan, we're going to go right into it because this is episode 2 of our series on investing. Allie did a magnificent job breaking down various taxes. Very dry, terrible subject matter. But she did a great job trying to lighten it up and make it fun, as fun as you can make taxes. So we appreciate that. Let's venture in now and talk a little bit more about investing as a whole. So you mentioned to me before we were cutting the show that a lot of times people will say, I'm investing my 401k or I'm investing my Roth IRA or whatever it might be. Talk to me a little bit about the nuance behind why that terminology is not very accurate.
Yeah, I think a lot of people, they think, okay, I buy my Roth or I buy my 401k. But remember, these are just buckets. All the things Allie just talked about on the last episode, your 401k, your Roth IRA, your brokerage account, whatever it is, that's a bucket that houses investments. So the investments are inside of that bucket. So if you have a 401k, you have a lineup, a list of investments that you can put inside of that bucket and you can buy with the cash or the money that you put in there every paycheck.
I think it's like the analogy she talked about with the tax brackets. It's the 7-layer dip. And I think it might be worthwhile to talk to people about at the base of almost all investments are either stocks, which are shares in publicly traded companies, ownership. So those are companies like, Microsoft or Apple or Nike or whatever, companies that they have shares. And when I say at the base, I mean when you go drill down 401k and the mutual fund and all these things, at the base are stocks or bonds. Now, for today's episode, we'll stop there. There could be commodities like gold or silver. There could be currencies. There could be a lot of other things as a base. But for most people, you're going to be looking at stocks or bonds. Now, that's the base layer. But above those layers could be what? Mutual funds, ETFs. So I want you to explain that a little bit. And then above that layer could be the account or the bucket that you're talking about. So break down those things a little bit.
Yeah,
so
let's kind of go layer by layer. So when we're talking about stocks versus bonds, which again, you're perfectly accurate, that's the base level of what you're buying. So stocks, ownership in companies. Bonds is the debt of maybe companies or governments that they are issuing debt out there. They have to pay that back over time, and they pay you interest in order to get that. It's basically the flip side of a mortgage.
And why this is so important to understand the base layer is I've heard people say things like, well, I don't like the stock market, so I just buy mutual funds. And I go, what? Like, huh? That makes no sense. So if you own a mutual fund, more than likely it owns stocks. So they're like, well, I don't like to be too aggressive in the market, so I just buy mutual funds. And I'm like, have you seen some of these mutual funds? Like, what? So there's this confusion, and what they're being confused on, I think, and we won't get there right now, we'll get there in a minute, is diversification. So, but again, base, and we'll get there, base layer, stocks versus bonds, but then they're packaged differently. So talk about that.
So then you got your packages. So you have mutual funds and ETFs are really the two routes that you go. Now, there's a lot of subcategories of those. So you have mutual funds that are index-based. And an index is basically taking a lineup of different companies. There's millions of them now, a lineup of different companies and packaging them into one bucket. So talk about some of the big indexes we talk about.
Yeah, probably not millions of them, but certainly maybe hundreds. But we love hyperbole around here if you didn't know. So you can go back to the original, probably the very first index, which would be the Dow Jones Industrial Average. Now, we talked about that on a previous show. Where originally Charles Dow wanted a way to measure United States economic output, and he thought about, combining the average price of 12 of the most notable companies in America at the time. He called it the Dow Jones Industrial Average. It stuck. We now have 30 companies in that index. Another index, which is probably the most notable, is the Standard & Poor's S&P 500. That was redundant. Standard & Poor's stands for S&P 500. That is 500 of the largest companies in the United States, representing 11 different sectors, everything from healthcare, energy, technology, communication, etc. Those are probably the two most notable indexes. There's also one called the Total Stock Market Index, which is over 5,000 publicly traded companies. It owns every stock that's traded in the United States. Now, the irony, and I won't spend too much time on this, is that they all pretty much move in the same fashion. If you look at them over a period of time, you'd be shocked at how similar they are in performance. And the reason is the weight, the size of the biggest components are often the biggest components at minimum in the S&P and the total market index. So right now, we have companies like Apple, Microsoft, Nvidia, etc. And as those big boys go, so goes the market. So again, I personally like to steer people either to the total stock market index or the S&P 500 index. Now, you mentioned millions, hundreds, or thousands. There are small cap index, mid cap index, international index, emerging market index. Now, the uniqueness of them is they own a set number of stocks. They rarely change, but they do change. They rarely change, but they do change. But they do not have a manager, a person coming into their office every day going, which stock should I buy? And historically, the index funds or baskets have performed over time better than almost every manager out there. And the reason is fees. It's very difficult to beat, having to already pay a manager a fee. Anyways, okay, so we have index funds. Then we have the active, that's the managers. So we have stocks or bonds. We have index or active mutual funds or ETFs, and those are housed within buckets.
Yeah, the account. Now you have your account level. So your account then holds on to these mutual funds or index funds or stocks or bonds. They're all in that realm. You're not buying a Roth IRA. You're not buying a 401k. You have these underlying investments that then make up your portfolio that you hold on to under there. We're going to talk a lot in the next episode about how do you buy the correct things, but let's talk a little bit more about that middle layer, because let's talk about the most common things people see. I think target date funds are probably the most common. When someone goes in their 401k, their retirement plan with an employer, what you're probably going to see that you're auto-invested in is a target date fund, which doesn't just have stocks, doesn't just have bonds. It normally has a combination of both.
So here's an analogy that I just thought of. My 15-year-old in the state of Kentucky now can get a permit, and he's driving with a parental guidance. When he's 16, he will get his license. Okay. Step one for him to drive is getting a license. Okay. Step two is securing a car. But just doing step one and step two will not really get him anywhere unless he really knows where he wants to go. And he lays out a roadmap to get there. Okay, step one in this process is the opening of the bucket or the account. Now, maybe it's as rudimentary as you're in your first week in HR. They're saying, listen, after 90 days, you're going to be eligible for this 401k. Sign these 3 papers, and you are going to get this bucket. You're going to get the 401k. Step two is what to put in that bucket. Now, what to put in that bucket is buying the various investments, okay? Now, unfortunately, the analogy dies here because my son can just get in a car and he's in the car. Like, you have to know what you're buying when you know where you want to go and where you want these investments to take you. Employers over the years have wised up. Here's what it used to look like. I'm in an HR class with 5 people. I get this sheet. Please fill it out. Hand goes up. Yeah, I don't understand these various funds. Can you help me with this? No, we can't help you with this. So unfortunately, I have no idea either. Okay, So he looks at his neighbor, she talks, what'd you do? Oh, you did that? Okay, you did that? Okay, great, I'm going to do that too. Turn it in. They never thought about it again, okay? Now, sometimes that was good. Oh, you went all total stock market? Okay, yeah, whatever, I'll do the same thing. Oh, you put 8% in? I'll put 8% in. Okay, great. Sometimes it was bad. Oh, I'm not aggressive. I'm doing 100% conservative. Oh, I'll put in 2%. Yeah, turn it. And then 20 years later, they dealt with the ramifications of that. Now, there were some big court cases surrounding that and surrounding education, the responsibility of the employer to provide education. The employer went back to the 401k providers and said, you're going to have to provide this education because we make widgets. We don't do 401ks. So those 401k providers came up with an idea. And the idea was really simple. Let's make sure at minimum that we put in an investment for these people that gets them from point A to point B without them having to think about it, without them having to do anything, and we'll call it a target date retirement fund. It was genius. It was brilliant. I mean, I don't agree with a lot of bureaucratic decision making at times, but this one was brilliant. So now, if you are a University of Kentucky employee and you participate in the 403B and you do nothing else, like I sign up for the 403B, which I think you have to, by the way. I sign up for the 403B, okay? And you then don't answer any other email and you delete every email and you just want it out of sight, out of mind. They will immediately put you in a target date fund that matches up with, I believe it's your 65th birthday, which means if you're 22, you are going to be in a long-dated target date fund that is very aggressive in the early stages and over time becomes less aggressive. It's diversified, it's rebalanced, and you never think about it. People can opt into those as well, even if they didn't decide, even if they didn't completely check out. So you have target date funds, which I think are beautiful, unless you want to go down the rabbit hole of, you know what I do when I get my car, my beautiful Tesla with my computer screen? I type in an address. Boom, 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 boom. Sometimes I'm coming to work. I type in the address. I want to know the best way to. I don't want to think about it. I don't want to think. I don't want to strategize. I don't want to look at maps. My wife, on the other hand, we're driving to the beach. Well, okay, I-40, there's some construction here. I'd really like to see this spot. She'll spend an hour figuring out our road that we should take to get to the beach. Me? No. Waze. Boom. It's telling me I'm going. Okay. Who are you? Like, what are you? Are you the type of person that wants to figure that out and all those different things, or do you just want to set it and forget it?
Yeah, we've done a lot of episodes recently where we've talked about that, where we talked about you got to know who you are as a person. Are you going to be the person that's going to look at your allocation, make adjustments and changes to it? Are you going to shift whenever life circumstances change and you think, oh, well, I'm now retiring 5 years early or I'm 5 years later? Are you going to make those adjustments and changes? Because if you are, then you're going to want to dive into your 401k or retirement plan and probably pick individual funds. You're going to want to pick a total market index, and you're going to pick an international index, and you're going to pick these other ones that have low cost. Again, that's normally the methodology we go by. Or you know yourself and you go, I'm going to log into this 401k once, I'm never going to look at it again. So I'm just going to go with a 2060 target date fund and know that in 35 years, I will get to where I want to be. So I'm going to stay with that index. I'm not going to worry about it. Each year, that target date fund is going to maybe sell a little of the stock side, buy a little of the bond side, and slowly shift me down in allocation so that when I get to retirement, this is important with the target date fund, you don't go to cash. It's not like, okay, the day I get to my 2060 target date, I'm in a cash fund. No, you're actually just in a less aggressive model than you were in your 20s, and now you're maybe a 50% stock, 50% bond fund as you've backed off risk, getting closer and closer to that designation. Or you are watching it, or your advisor is watching it with you, and they are helping you slowly peel back risk over time based on your individual risk preferences. Remember, a target date fund is just doing averages. Yeah, on average, someone that's in their 50s, maybe they're 70% stock, 30% bonds. But if you have a more or less aggressive allocation that helps you sleep better at night, or you're like, I want to be pedal to the metal and grow as much as possible, you can make those subtle shifts and adjustments inside of your portfolio.
All right, so we talked about the various buckets. Step 1, opening of the accounts. Step 2, the investments, mutual funds, ETFs, etc. Step 3, knowing that it's inside the bucket. We've already talked about the tax ramifications of each bucket. What else are we missing?
Yeah, I think we really need to talk about allocation and diversification. I just started down that road, but those are really two of the biggest principles. There's really 3 principles we talk about in our office all the time: allocation, diversification, timeline. Timeline is really important. You got to know when this money is going to be accessed. You have to have some relative goal for when you're going to need that. 5 years or less, don't invest it. Maybe in that 10-year time horizon, you're not going to be nearly as aggressive as something that's going to be 40 years down the road. So timing is important. Quint, why don't you speak on allocation and diversification?
Yeah, I talk to a lot of groups that I might never see again. That's always dangerous, right? So you never give stock picks. You never tell them your general idea at the moment, because it could change next Tuesday and they're not around. But so I came up with this concept of ADR, allocation, diversification, rebalancing. If someone is going to do their own investing, or they don't have a financial advisor, et cetera. And it really has to do with your overall big picture allocation for all that you own, whether it's real estate, cash, stocks, bonds, retirement funds, et cetera. And the first being allocation is the difference between risky assets and fixed assets, or non-risky assets. And the reason I say risky assets is that doesn't just mean stocks. That could be real estate that you've invested in. That could be, other business ventures. It could be really anything that could be volatile. And safe assets are going to be your cash, or your treasuries, or, your fixed income, your emergency fund, et cetera. Okay. There's a general rule of thumb, and these are dangerous, but this is a general rule of thumb, and I think it's a good guideline. You take your age and the decade you are in. So, for example, I'm 47. I'm in my 40s. You minus 10. So that's 30. That is the percentage that should be, in my opinion, in overall fixed or safe assets at my age. So let me walk through it again. 47, that's my 40s. Minus 10 is 30. I should have a 70-30 allocation. And even in my big picture allocation, try to adhere to that. All the various things I have kind of going on, other, real estate or investment properties or whatever it might be, I sort of adhere to that. And when I look at my big picture balance sheet, I say, okay, I should be about 70-30. Why is that important? Well, the third letter in that, a DR, we'll come back to the diversification, R, is rebalancing. And one of the most dangerous things for especially young investors who are aggressive is watching their risky assets grow and never rebalancing onto the safe side. Now, I'm not saying market timing. I'm not saying, you had a hot stock that jumped or an investment that did great and, you're going to pull it to cash. No. I'm saying that anytime, just like we do for our clients, that I look at my overall portfolio and I find that due to appreciation or depreciation, I have swung my pendulum, let's say from 70-30 to 75-25. I will look at trimming about 5% of that and moving it over to fixed income. I always want to be rebalancing my overall allocation. Alternatively, when it's bad and for whatever reason, the risky assets are down, and I look and I go, gosh, I'm now 60-40, right? Risky assets are down. And so when I look at the whole thing, my stocks or my investments versus my fixed income of cash is now 60-40. I will take monies from that side of the safe equation and invest to bring it back up to 70-30. And I usually look at that big picture about once a year. If there's extreme volatility, I'll look at it in the time period that we're in. But about once a year, I'll do a big picture. And listen, I'm going to be 48. In a couple of years, I'll approach my 50s. I will look at increasing my fixed portion from 30 to 40. Now, will I do it day one on my 50th birthday? Probably not. I'll have to look at taxes. I'll look at a variety of things. But my goal will be to get less aggressive as I get older. And that's also my personality. We know people in their 80s that are like, don't ever buy a bond for me. I never want to own a bond. I want to be peddled to them. That is not me. It's just not. I'm quite honestly pretty risk averse. Now, diversification is also sort of a personal. I don't have a fun, rule of thumb for this or any sort of acronym, but I do think it's important to be well diversified. Now, that could be, ironically, if you're only in a 401k, the S&P 500 is 500 companies, 11 sectors. Now, it is pretty heavy weighted to a few groups of companies right now, so that concerns me a little bit, but it's pretty well diversified. But you can get through a target date fund or speaking to an advisor or just doing a little bit of research, you can be a little bit more diversified. I would say the only two general rules of thumb I have for people is when they're working and they're invested in company stock, I don't like to see that investment be 20% more 20% or more than their overall net worth.
And what you're really talking about is if someone worked at Toyota and they got Toyota stock, for instance.
Or got
wherever,
options or whatever.
And that, as far as your overall portfolio percentage.
That's correct. Well, in your overall portfolio, like in your 401k or your investment, if all of a sudden, you got $100,000 and 30,000 of it is in one stock that you work for, that's 30%. For me, that's too much. Now, you might make a decision, listen, no, I believe in this company. I'm here. Okay, great. That's fine. That's your decision. I'm just saying I'm uncomfortable over 20. And when you're retired, I don't like that number over 10. So I see retirees who've worked at a company for 25, 30 years, and they're like, no, I'm going to keep this whole group of, this one stock. Well, you're running the risk that if you're no longer showing up to work every day, you don't know what's going on there, and if all of a sudden they start to fall into hard times, you really suffer. The only other one is, personally for me, I don't like to have any illiquidity above 10% of my overall investment portfolio, and that's everything. So a lot of times I turn real estate or other opportunities down because I'm already at 10%. 10% of my net worth is in illiquid investments, and therefore I can have no more.
And when you speak on illiquid investments, these are things that take a long time to get out. So if you had to sell a real estate property, that's probably not going instantly, or even more like a deal that's out there where you invest in something and they're like, for 5 years, you can't touch this money.
That's right.
Or for 10 years, you can't touch
Yeah,
this money.
and again, most of the time it need to be an accredited investor. You're going to do your due diligence. This is certainly not for the vast majority of our listeners, but I just know a bunch of people, they want, I got to own property. Like, I want to own a duplex. I want to own a rental, blah, blah, blah. Okay, keep it in alignment with your overall net worth. Now, candidly, when I started this business, every dollar I had was in this business. Like, there's been times in my life, all my chips are in the table. Charlie Munger, famously, Warren Buffett's partner until he passed, would always say, put all your eggs in one basket and watch the basket. And so, or maybe it was Stan Druckenmiller said that. Anyways, whoever said that, one amazing investor said that. But there are times when, you're starting a business or you're believing in a concept and it could fail and you could lose everything. And, that's the most amazing thing about America is the ability to do that, but it's also dangerous and it's certainly not for everybody.
Yeah, absolutely. All right, take a listen to our next episode where we're going to dive deep into, maybe you're one of those people that really wants to understand stocks and understand buying companies individually. We're going to talk more about that in the next episode, but everyone have a good one.